Increasing marginal returns in the production function of money under fractional reserve banking.
Dante Bayona.
I will present the case for the supply curve of loanable funds to be downward sloping, by analyzing the possibility of increasing marginal returns in the production function of money. I will first adopt a Manchurian approach to guide the analysis of the slope of the curve. Then I will examine the role of fractional reserve and collateral in the production function of money. After that, I will explore the role of securitization in the production of new loans. I will examine the total supply of loanable funds that is created through the banking system, not only the central bank's supply of currency. Praxeology of the supply curve. Generally, in economics, when we talk about supply and demand, we think about a downward sloping demand curve and an upward sloping supply curve.
There is a well-known praxeological explanation for the downward sloping demand curve, and a less-known explanation for the supply curve.
As the Polish economist Karl Menger explained in 1871, if a farmer possesses 4 bushels of wheat, he will assign their use in order of importance. Thus, the farmer will use the first bushel for food, his most important goal, the second bushel as seed for the next harvest, the third bushel to feed his animals, and the fourth bushel to make beer he enjoys. If the farmer had no wheat at home and had to buy it at the market, he would be willing to pay more for the first bushel, for food, than for the second bushel, for seed, and more for the second than for the third bushel, for feeding his animals, and more for the third one than for the fourth bushel, for making beer. Thus, the demand curve is a reflection of marginal utility. From the same logic of human action, the supply curve can be deduced. Suppose the farmer's neighbor decides to start producing beer and wants to buy wheat from our farmer. To induce the farmer to sell his wheat, the neighbor will have to pay progressively a higher price for each additional bushel, since each sale requires the farmer to forego progressively more marginal utility. Thus, the farmer will demand more to give up his third bushel, for feeding his animals, than his fourth bushel, for making beer, and more to give up his second bushel, for seed, than for his third one, and more for his first bushel, for food, than his second one. Therefore, the neighbor's supply curve, which reflects the minimum price he is willing to charge to bring additional quantities of beer to market, has a positive slope because it reflects the progressively increasing opportunity cost of the scarce input, wheat. The neighbor's increasing opportunity cost is the inverse of the farmer's decreasing marginal utility. When gold was money, when money had to be backed by gold, the supply of loanable funds was an upward sloping curve. It was upward sloping because the supply of gold was upward sloping. Mining gold was, and is, an expensive enterprise. But nowadays there is nothing backing up money. Central banks can create money by tapping a few keys on the computer keyboard. No scarce resources are taken away from other economic activities. There is no opportunity cost, no marginal utility has been given up, therefore according to praxeology, this supply of money cannot be an upward sloping curve. Both supply and demand are the result of human subjectivity in a world of scarcity. Because there is scarcity, we must rank our goals. But what happens when there is no scarcity of resources to create money? From Greek mythology, we know the story of King Midas. The gods granted him the power to turn everything he touched into gold. That is, Midas had an almost infinite money supply. For Midas, the opportunity cost of making money was almost zero, because he first needed a physical object to turn it into gold. At first, Midas was happy, but later something like hyperinflation occurred, the value of money dropped significantly, and Midas begged the gods to lift the curse. In today's monetary system, to create money out of thin air, banks do not even face the negligible production cost that Midas had. A few keystrokes on the bank's computer, and it is done. The upward sloping supply curve in mainstream microeconomics.
How do we get to an upward sloping supply curve in mainstream microeconomics? We assume diminishing marginal returns.
Diminishing marginal returns refer to a property of the production function, which describes how total output changes as the quantity of one input increases while keeping the others constant. For example, it means that if one factor of production increases by 10%, the output increases only by 9%. In turn, this means that producing an additional unit of output will now require more resources. The supply curve reflects that producers must receive a higher price to supply an additional unit, since producing more requires an additional opportunity cost. Increasing marginal returns implies the opposite, which is, when a factor of production increases, let us say, by 10%, the output increases by 11%. Does the concept of diminishing returns apply to the production function of money? The production function of money under fractional reserve has a property that other production functions do not have. The output returns to the factory as an input. When John D. Rockefeller's Standard Oil Company produced a gallon of kerosene, once that gallon was sold, it was completely consumed. The gallon of kerosene did not return to Rockefeller's refinery to produce 5 more gallons. But that actually happens with money. Under fractional reserve, assuming a 10% reserve requirement, an initial deposit of $100, factor of production, generates a loan of $90, output. After that loan will return to the factory as a new deposit, factor of production, and it will generate another loan for $81, output. Again, that loan will return to the factory as a new deposit, and the cycle repeats several times until the multiplier is exhausted. At the end, the original factor of $100 has created $900 in loans, credit money. Then, fractional reserve multiplies the input and multiplies the output. Does this mean that fractional reserve implies increasing marginal returns in the production function of money? No, in this specific function, fractional reserve does not imply increasing marginal returns, because if we deposit an additional factor of production, $100, it will also generate $900 in loans. Fractional reserve only gives us constant marginal returns. The role of collateral in the production function of money. Our analysis of the production function of money would end here if money merely circulated from hand to hand, like collectible cards or poker cards. But money affects real scarce resources. Money mixes with real scarce resources. Money is used to bring natural resources to production. It is used to build factories, houses, cars, etc. Money is used to bring labor to action. And those factories, houses and cars are later used as collateral for new loans, allowing even further credit expansion. In our previous example, if the first $90 loan is used to build a house, that house can be used as collateral for a second loan. The first loan has made the second loan cheaper. The first loan has added something to the production function that makes the second loan more productive. The second $100 deposit now has a larger base upon which to expand. The whole economy will expand on collateral that did not exist in the first round of credit expansion. Now, this is more than fractional reserve. This could be characterized as increasing marginal returns. Increasing marginal returns implies decreasing marginal costs, which in turn implies a downward sloping supply curve. Securitization in the production function of money. New developments in finance have enhanced increasing marginal returns in the production function of money. Traditionally, when a bank gave you a loan for $100 to buy a house, you took that check and gave it to the seller of the house. The seller would deposit the check into his bank account, and with that check his bank would create a new loan. And the bank that gave you the loan would keep the house as collateral until you finish paying for the house in 20 years. It was a slow process, economies of scale. But now that has changed. The bank that gave you the loan can make more money now by selling your house, the $100 loan, to be packaged into mortgage-backed securities than by keeping it for 20 years. Let us say the bank sells your loan to Wall Street for $110. With that money now it can make more loans. A slow process that used to take 20 years now takes only a few months. More than lending, the business of banking now is to provide inputs, mortgages, to Wall Street. While in the old system before securitization, only $100 came back to the system, when the seller deposited the check into his bank account, now an extra $110 from securitization comes back right away to the system to make more loans. This reinforces the case of increasing marginal returns in the production function of money. Production function of credit money. The production function of money with increasing marginal returns under fractional reserve may look like this. Where M. Supply of loanable funds. D. Initial deposit. Alpha. Fractional reserve ratio. 1/alpha money multiplier. Beta 1 represents increasing marginal returns. A represents financial engineering through traditional banking and shadow banking. Financial innovation allows the same amount of deposits to support more loans, for example. By converting mortgages into mortgage-backed securities, it allows banks to make more loans without needing more deposits. Derivatives that provide insurance against certain losses, credit default swaps, allow banks to originate more loans. Rehypothecation in shadow banking allows the same collateral to be used by multiple institutions simultaneously. Conclusion. Securitization clearly supports the case for increasing marginal returns in the production function of money under fractional reserve. This implies decreasing marginal costs and a downward-sloping supply curve for loanable funds. In the real world, firms seek downward-sloping supply curves, they seek increasing marginal returns and economies of scale. Do Microsoft or Apple look for upward or downward-sloping supply curves? The best way to compete is achieving downward-sloping supply curves. It is the best way to eliminate competitors and become the dominant firm in the market. That is the way Rockefeller's Standard Oil competed. Yet, while Microsoft and Apple face the real scarcity of the economic world, the banking system does not. Downward-sloping supply curves allow for the analysis of economic phenomena that mainstream theory cannot explain. Downward-sloping supply curves allow for the construction of general disequilibrium models, as I have argued in other papers. Upward-sloping supply curves always guarantee general equilibrium. Downward-sloping supply curves allow the existence of general disequilibrium.